Thanks everybody for joining us this afternoon. I can see there's quite a few still logging in, but we can get started. Before we get cracking with today's session, just a few bits of housekeeping to take care of first. So as always, this webinar is being run to coincide with the release of our next batch of quarterly reports, and they are going to be released in the coming days. So for those that do receive those, do keep an eye on your inbox. As always, the session is also being recorded, so we will make sure that everyone on the session today will receive a recording again in the days to come. As always, delighted to be joined by an expert today, which is Kim from Unite Students, and really look forward to having a discussion and going through her presentation shortly. Ahead of that, though, it is worth bearing in mind, whilst we have had quite a few questions submitted in the run-up to today's session, there is the Q&A function within Zoom. So if you're able to find that at the bottom of your screen, do feel free to send in some questions. We'll see if we have time towards the end of today's session. And if we do, we'll try and run through as many of those as we can. On that note, before we get running with today's presentations, Kim, if I can just hand it over to you for 30 seconds or so for a quick introduction.
Hi, I'm Kim Nisbett, Head of Data and Insight at Unite Students. And through my presentation, I'll talk a little bit about myself, Unite, and some of the sort of things we're considering in terms of the market.
Perfect, thanks very much. Before we get started, as per usual, we've actually got a quick poll that we're going to launch. So if you bear with me 2 seconds, I'll launch this and we'll see what the results are towards the end of the session. So it should be popping up on screen any moment now. So there's 3 very simple questions. We've actually been running these same questions for a number of sessions now, just to see how the answers are evolving over time. The first one is, what are your rental growth expectations for 26-27? So we can see those answers coming in now. We've then got, what are your expectations for PBSA leasing velocity this year versus the 25-26 season? And the final one is, we have, how has your overall view towards the student accommodation market shifted over the last 3 months? So you can see quite a lot of answers coming in already, which is great. As I say, we'll revisit these towards the end of the session. It is worth noting you can minimize that poll, so you don't have to leave it open. But again, we'll keep that running in the background, and then we will revisit the results towards the end. So on that note, let's get started. We've got quite a lot to get through. There's a lot going on within the sector, as you're probably well aware. My presentation will probably run for about 30 minutes, and then we'll hand it over to Kim. And again, look forward to hearing her perspective. A lot of you on the call will be familiar with what we do, but for anyone that is not, to give you a very quick overview, to split our business into 3 parts. We have the listings platform, StuRents.com. That's been going since 2008. And we advertise, roughly speaking, about 750,000 beds. And that's a mixture of both PBSA, but also HMOs. We are also a leading provider of property management software to the sector, and that's via our separate brand called Concurrent. And you can see to date, we've executed over 3.5 billion in tenancy value. And then from a research standpoint, we leverage those 2 platforms, supplement that data where we need to provide highly granular independent insights to a real range of stakeholders within the sector. As I say, there's lots to cover in the next 30 minutes or so. Just a quick highlight in terms of the topics we're going to be exploring. We're going to start off by looking at the change in dynamics over the last few years, which again have been interesting, to say the least. We'll go through that in a bit of detail. We're then going to dive into actually the latest data from the Office for Students, which is actually only released yesterday, but there's some interesting trends to explore there. We'll then look at some of the early demand trends for the 26 cycle before we move on to PBSA leasing velocity. And then finally, we'll touch on changes to supply as well as planning, and also looking briefly at rents and tenancy lengths as well. So lots going on from a demand perspective. And as I say, we wanted to start by revisiting some of the headline numbers. As I said, we're going to explore the OFS, or the Office of Students data, in more detail shortly. But to begin with, we are at the moment on this slide looking at the latest data from HESA. Now, previously in 2025, around November time last year, we released our annual report. And in that report, we predicted or posited that demand likely fell in the 2024 cycle. HESA released their most recent data a few weeks back now, and that did prove to be the case. We can see from the chart on the right-hand side, the dip for the last 2 years and possibly into 2025, which again, we'll explore shortly. Now, to give some context here, just to explore these numbers in a bit more detail, if we look at all of that data from HESA and actually exclude what we classify as alternative providers, the total number of students for the 2024 cycle was down about 1.9%. Now, what's important to note there is that is being driven entirely by the postgrad market. So postgrad numbers fell by about 14.7%. Undergrad demand actually remained up. So we've got a quite big divergence between undergraduate growth and changes to postgrads. So as I say, demand from a totality perspective has fallen for the last 2 years, possibly 3, but that does actually follow on from 10 consecutive years of growth, which we can see on the chart on the right-hand side. So worth putting into context over the long term. Yes, it's a short-term blip, but over the long term, it is still very much has been historically on the rise. So what do these headline demand changes mean for fundamentals? Now, the chart on the right is how we typically look at supply and demand. This is quite different to what many other stakeholders in the market typically report. We deliberately do not report on student-to-bed ratios or headroom analysis. To explain briefly how this chart is depicting the market, the navy line is the cumulative change in demand for accommodation over time. And we can see for the 24 cycle, that has likely come off, as we just alluded to with regards to the HESA data. The 2 orange lines are different scenarios, which I'll explain shortly, but it's tracking the change in supply over that same period. Now, if you're interpreting the chart, what's quite interesting to note is that between 2020 and up to about 2023, we can see that navy line as being significantly higher than either of the 2 orange lines. And that means demand growth was significantly outstripping supply growth. And that really coincides with what we saw in the market in terms of very strong leasing velocity and in most cases, double-digit rental growth. As I say, post 2023, with demand having subsequently fallen, what we're now starting to see is that spread has materially narrowed. And if we start with the light orange line, we can see that. And that does suggest that those market fundamentals from a supply and demand perspective have become more challenging than in that previous period, which I just explained. Now, I guess slightly complicating the picture further, what we've started to look at in a lot more detail is how BTR is then changing that picture again. So the darker orange line in this analysis now includes a proportion of the BTR market. And we know, for example, that some BTR schemes do have quite a wide range of exposure to students. But if we take some assumptions around what that exposure looks like, we can again see how those fundamentals have shifted once we include BTR. And actually on that basis, it now starts to suggest that supply growth has outstripped demand growth, again, because of the more recent falls in total number of students. So fundamentally, the market has shifted somewhat in the last few years. Having said that though, looking ahead, it won't take much from a demand growth perspective to make those fundamentals improve. So again, we're not needing or requiring significant increases in demand for the market to improve and potentially improve quite quickly. So that is worth bearing in mind. As I say, the OFS reported their more recent data yesterday, and we're going to explore that in a bit more detail. To recap very quickly, just to highlight some key differences here. So the Office for Students report on technically what they classify as early estimate data. However, the benefit of using this particular data set is it goes up to 2025. So yes, it's a little bit delayed still, but it is more up to date than HESA. The downside is it only covers England. And as I say, it is technically early estimated data, so it's not going to be the final figures. However, it's important to use because as we can see on the right-hand side, what the data is suggesting is again, demand growth from undergraduates, but again, that's being offset by a fall in postgraduates. And therefore, it is likely that demand has actually fallen for 3 consecutive years. As I say, we don't know for sure. We'll have to wait till this time next year when HESA finally release their numbers. But again, the OFS data is suggesting that. To give some context there in terms of figures, the total was down about 1.6%. Undergrads up 2.5%. But as I say, postgrads are negative 18%. So that fall in postgrads, again, is a drag on the total and has pulled the total down. Isolating what the OFS classify as overseas students next, obviously that's a key demographic for a lot of the PBSA market. Again, it's a very similar trend. So the total is down, not quite, but almost 5%. Again, positive growth from undergraduates. You can see 4.6%. But postgrads, another fall, this time about 13%. So it's a very sort of similar story from a national perspective, as well as looking at specifically overseas students. What is worth noting is that longer term decline. So if we look at postgrads, those numbers are down about 28% compared to the peak in 2023. Again, there are a bit of added context here, and it is quite clear from the chart on the right, particularly focusing on the postgrad bar, that coming out of COVID, we did see that significant spike in international postgrads. And yes, it has come off in the last few years, but again, we can see over the longer term, if we compare the 25 numbers, say to 2020, they are still up. So I guess the next question is, will we see that slide continue or will it stabilize? And that's somewhat of an unknown kind of at this stage. So let's now consider some of those changes from a locational perspective. And this is focusing on the headline figure, so the total number of students for each location. And again, what the OFS is indicating has happened to those figures year on year in 2025. As you can see, we've taken a dozen or so specific locations here. And again, it's a real mixed bag. We've got Plymouth, surprisingly Coventry, which is seeing a bit of a rebound, but Coventry reporting year on year growth. Whereas at the other end of the scale, we have Nottingham, Canterbury and London, for example. Now, with London specifically, again, not isolating or not different to the national trend, undergrad numbers were up. They were up almost 7,500 year on year, but it's a significant fall in the postgrad market that again has dragged that total down, and therefore the total decline is just over 9,000. So as I say, undergrad demand seems to be pretty strong. It seems to be growing, but it's that postgrad market and that postgrad volatility that has certainly been the challenge in more recent years. Looking at that same data, but over longer time periods, we can start to understand the trends in a bit more detail for specific locations. What this chart is showing is the change relative to the figures reported in 2018. So if we were to take some of those more positive locations, so let's start with Bath, for example, you can see that there were not quite, but almost 25,000 additional students in 2025 relative to 2018. Birmingham showing some strong growth, Manchester still up over the long term as well. At the other end of the spectrum, we have Sheffield, Brighton, Coventry, all down over the long term. Again, as I said earlier, Coventry has rebounded somewhat in 2025, so you can see the line going upwards for that period, but it is still down compared to the figures reported in 2018. So that kind of flight to quality trend, and I guess that divergence between those universities and locations that are performing well is very apparent, and we can see that in the data, particularly looking at on this basis. Moving on to look at, again, one of the key demographics, which is your overseas students, and again, highlighting a dozen locations and seeing how that has changed in 2025. As we can see, Coventry again comes up, has actually rebounded. So we're looking at about 1,500 additional overseas students for 2025. But equally, we've got some interesting locations here. We've got Hull, we've got Derby, possibly even somewhere like Norwich, which has actually seen an increase. So it's not always the case that the more prestigious universities are reporting growth, and there are some edge cases, which is worth to note. At the other end of the spectrum, probably won't surprise people, but we've seen Nottingham, and that number has fallen again. And actually that decline has coincided with a rise in supply, and that's something we've covered quite a few times in these sessions before. Manchester, Exeter, probably worth calling out as well, possibly Southampton as well there. Fairly significant declines from a year-on-year perspective. Having said that, we wanted to then dive into, again, specifically overseas postgrads. Now, the reason for that is that particular demographic has been very volatile, and we'll see this over the next two slides. Having said that, some locations are still up. So in this particular case, again, just for clarity, what we're looking at is the number of overseas postgrads over time and how does that compare to the figures reported in 2018. So if we look at something like Manchester, Manchester's quite interesting. We can see that in 2025, there was still, roughly speaking, about 4,000 more overseas postgrads compared to 2018. But the challenge in a market like Manchester, we'll see some more locations shortly, is the level of volatility. So you can see that line spiking significantly coming out of COVID, and then it has come off again pretty quickly. If we pick out those key numbers, we can see that between 2018 and 2023, there was growth of 8,800 overseas postgrads. However, if you then fast forward to 23-25, there was then a reduction of almost 4,700. So these huge swings going from very significant growth to some quite significant reductions. And that volatility has made it very difficult for the market to predict how certain locations or certain universities are actually performing. Having said that, though, again, all of these locations are up over the long term. So yes, has been volatile, but again, numbers on the whole are actually up over the long term. Again, Coventry, to pick that out, that's seen again a bit of a jump in 2025. Looking at some, I guess, possibly less favourable locations next on the same basis, we can see, for example, if we look at Loughborough, Brighton, Bath, Egham, those numbers are down in 2025 compared to 2018. Picking out Leeds and Nottingham, they're two markets that have had a lot of focus more recently. And again, this really highlights, I guess, some of the challenges and also some of the difficulties in trying to actually establish what has happened with demand. If we take Leeds as an example, very similar to what we saw with Manchester, significant growth in overseas postgrads coming out of COVID. In 2024, that then fell very significantly, but more positively seems to have stabilised for 2025, which is really good to see. Nottingham, not quite there. Again, significant increases and then a significant fall. But it does mean in Nottingham, numbers in 2025 are now actually lower than where they were in 2018. So as with a lot of the trends in the market, a real mixed bag, and the performance at a locational level, let alone any specific university, does vary significantly. And I think that volatility is, again, a key trend that has been playing out for the last 2 years. And as I say, that has made the market a lot tougher to predict, but it's also caught some out, probably by surprise, because they weren't expecting such levels of volatility. Moving on to some of our proprietary demand side data next. And to begin with, we're going to start to look at the changes in search behaviour now that the latest 26-27 letting cycle is underway. We just wanted to highlight how that changes compared to the previous quarter. So the chart on the right is looking at the Q1 26 period. For clarity, that actually refers to October to December last year, and we classify that as Q1 of the 26 letting cycle, and that's when the letting cycle for 26-27 commences. We can see during that period a significant skew to larger units, so 4, 5, and 6 beds, for example. That is very much expected. So what we would typically see is most or a significant proportion of the domestic market house hunting very early, again, October to December time, and they are typically house hunting in groups, which is why we see that demand for 4, 5, and 6 beds in this case. We can see how that has changed. So about 82% of all searches were for 3 beds or more. And if we compare that to the end of the 25-26 cycle, it's chalk and cheese. We can see how it's completely shifted. As I say, though, that is very much expected. That is broadly in line with the trends we see each cycle. Something that we have, I guess, flagged in previous sessions, and it's still the case for some within the market, particularly for PBSA, is that the UK domestic market in certain locations, again, does move very early. In some cases, as early as October. However, again, a lot of PBSA has not necessarily publicly released their pricing at that point. So again, maybe an untapped potential there to try and attract some of that very early domestic demand. Moving on, we wanted to then focus on that UK demand. As I say, that is the majority of what you do see very early on in the letting cycle. And this specific data set is looking at achieved contract values. So these are actually rents that have been agreed. And we can see that those are rents or contracts that have been agreed between September and February just gone. Now, what we've done here is we've plotted that data at various contract values, and we've just compared that to the same period in the previous cycle. Now, positively, what we can actually see is that for UK students, this is specifically looking at UK students signing contracts in the HMO market, they are continuing to do that at higher prices. So we can see there's about a 2.8% increase in contract value. I'll explain a bit more about contract value towards the end, but that's obviously a key metric rather than just looking at the headline rent. It's also worth noting that there is still a big preference from UK students to go into the HMO markets. That is still very, very attractive to that particular demographic. In terms of the contract values, we can see the figures on screen. So as I say, for this current cycle, at least those contracts signed between September and February, we're looking at a value on average of about 7,700 or just over, and that's up from about 7,500 for the same period last year. So again, 2.8% increase. For UK students going into PBSA, again, to date at least, we're looking at a contract value of about 8,500. It is up compared to the last cycle, but 1.4% increase. So not quite as strong in terms of that value growth compared to what we're seeing in the HMO market. It's also worth noting, though, that those students from the UK who are deciding to live in PBSA are paying a premium compared to the HMO market, and that's about 10.6%. Those numbers will evolve as we continue throughout the rest of the letting cycle. Looking at that same HMO data over time, we just wanted to highlight how that has developed. And we can see there is a lot of volatility within the data. Obviously, the contract values that are being agreed does fluctuate, but you can see that over the long term, that has steadily risen over time. And that, again, supports the argument that there is strong demand for HMOs. As I kind of alluded to already, we do see significant peaks and troughs through any 12-month cycle. And actually, typically what we'll find is that domestic students house hunting in the HMO market at the very early stages of that cycle are actually paying a premium. So they are going to be looking for the best quality HMOs and securing that early. And then typically what you'll find is that over the rest of the cycle, that contract value comes down somewhat. So again, early movers paying up. And again, that's interesting to note for PBSA. That might again be untapped demand that might be worth thinking about. So let's now consider how all these trends are playing through into PBSA leasing velocity. So we now have, roughly speaking, about 240,000 beds taking part in our monthly PBSA occupancy survey. To start off with, looking at all the data we collect on an aggregated basis, we can see how that velocity has changed over the last 3 and a bit cycles. For January, just gone, we can see that we are tracking there or thereabouts the same as last year. It's down marginally, but we're looking at about, I think, about 0.9 points, so not a significant reduction by any means. It's about 20.5% of beds in the survey have been booked to date. We'll obviously keep a very close eye on this and see how this develops throughout the rest of the cycle. Looking at studios, it's quite similar. So again, as of January, about 22.8% of those studios in the survey have been booked, and that's down 1 percentage point compared to last year. What's worth noting, though, is actually we've seen that spread narrow. So if you can just about see it on the chart, if you look back to November, you'll see the difference between the orange line and the blue line was slightly higher, and that spread has actually started to narrow, which is positive. We'll see if that momentum is continuing, and if it does, we might see the blue line cross the orange line. But again, we'll keep a very close eye on that in the coming months. For clusters, again, very similar, tracking last year there or thereabouts, about 0.9 points down at this point. Again, though, we have seen that spread narrow over the last few months. So again, that's at least some positive momentum that we are seeing. Moving on to planning activity and supply growth next. And a chart that we typically include in these sessions looks at the level of planning activity. The chart on the right is depicting the 12-month rolling figure, either for those beds that have been submitted or for those beds that have been approved. So if we look at the data for last year, then we're looking at about 33,000 beds put forward. That's down compared to the 47,000 in the previous year. And as you'd probably expect, similar for those beds that have been approved, so about 32,000 approved. And again, that's down from about 37,000 approved in the previous year. So we can see on the chart on the right how that kind of activity has fluctuated over time. Obviously, took a bit of a dip kind of around the 2020 period, started to increase again, but that has now come off. I know Kim's going to touch on, I guess, levels of pipeline per location, but it is worth noting that whilst total activity is down and remains relatively low, it is very much skewed to relatively few locations. And if you look at the top 10 locations, as we can see, they're about 70% of all beds in planning are located in just those 10. So that is worth noting. On a similar theme, looking at those planning hotspots, so this chart on the right is not showing the total level of planning, it's showing the number of beds submitted for the whole of last year and where they were located. So if you look at that activity last year, we can see that over half of all beds put forward in 2025 were in 3 locations, and that's London, Manchester, and Glasgow. Bristol has a relatively large proportion as well, at around about 11%. So as I say, yes, planning is relatively low from a national perspective, but it is very much skewed to a probably handful of locations, really. What's worth noting is when you start to then look at the pipeline in specific locations, because of that activity, certain locations do have significant supply growth potential. So if we look at Glasgow, for example, supply there could, in theory, increase by 77%. In reality, that's not going to happen. We know that a significant proportion of the beds will not get delivered, so that's worth bearing that in mind. And actually, when we've looked at historical data on this, depending on the location and what periods are being analysed, it can be as low as 20% of beds actually have been delivered historically. So we can start to use that kind of insight to discount the pipeline and start to allow our users to have a more or better grasp on how supply and demand might be changing in the future. As a natural follow-on to that, that's then flowing through into supply growth. So this chart is looking at the number of new PBSA beds delivered, and it actually broadly follows that activity chart we saw a few slides ago. So the number of beds being delivered historically was on the decline up to about 2023, has increased somewhat for the last couple of years. The 26 number on this chart is not yet finalised, that will continue to evolve. What we can also see from the chart, what's quite interesting, is that if we cast our mind back to one of the first slides, when we saw supply and demand at the national level, 2023 was obviously included in that period where we were seeing significant demand growth, yet supply growth was very limited. As we can see, about 11,000 beds roughly were delivered. If we again cast our mind back to 24 or 25, we have a decline in demand, yet supply growth is still increasing. So again, it's just interesting to note those trends. Having said that, as we've just seen from the activity chart, because that pipeline activity has been falling, the long-term outlook is that the number of beds being delivered nationally, at least, again, this will vary significantly per location, but at least nationally, will remain low. And I don't think we're going to be getting anywhere near the levels we saw in, say, 2019, for example. So that's going to be positive in the medium to long term. So far, we've kind of looked at PBSA growth, and we've looked at that from a national perspective. We did look at how BTR is changing that, but we wanted to focus on specifically on Leeds for this example. Again, it's a location that's come up quite a lot in conversations over the last couple of years. And again, this highlights, I guess, some of the challenges for the sector, both in supply and demand, but also in the analytics. So similar to what we saw at the start, the chart on the right is depicting the change in demand for accommodation, which again is the navy line, versus the change in supply, which again are the 2 orange lines. So we can see in Leeds, up to about 2023, we saw demand growth outstripping supply growth. We then saw a fairly significant fall in demand, and that's represented by the dashed line. And again, similar to the national perspective, it means that spread significantly narrowed in 24 and in 25. Now, adding another layer of complexity, as I mentioned, is the BTR market. So we do, again, have to make some assumptions around this. So for example, assuming a proportion of the students are going to BTR. But if we do that, we can then see that in this particular case, the orange line is quite significantly, or the light orange line, I should say, is slightly higher than the darker line. And that does show that those fundamentals do look quite different, actually, once you start to include BTR. I think the challenge for the whole sector, and again, Leeds is an example of this, I think it has been a bit of a blind spot for the sector. I think BTR was known, but it wasn't really being looked at in any great depth, and now it needs to be. The challenge there is that trying to get good quality data from the BTR market is more difficult, and that's going to potentially, again, lead to some blind spots. I think also there's a risk because we do see there is still a lot of appetite for investment into UK PBSA, but I would argue that going forward, we need to be looking at PBSA, BTR, co-living, potentially even single family housing, as well as HMOs, to really get a real strong grasp on what is the level of supply in any given market. That, again, adds another layer of complexity to that analysis. So I do think there are opportunities to improve that and also explore collaboration with other asset classes to make sure we're not seeing capital being deployed into markets when actually it probably shouldn't be, because supply and demand is maybe not at the levels that the user is expecting. On planning, again, we're tracking this monthly across essentially every location in the UK. I'm not going to read these verbatim, but we can see some of the highlights. Some pretty significant projects being both submitted and approved. Again, we're seeing a recurring theme here: Manchester, Glasgow, Birmingham, both from a submissions perspective, but also from an approval perspective as well. Final 2 or 3 slides before I hand over to Kim, and a topic we've been discussing quite frequently is the concept of rents and contract lengths. Now, this particular chart is actually leveraging the same survey we've just run in this session, but when we run it at the end of last year. And we can see at the end of last year, users were expecting rental growth. We can see 1.2 to 3.4%, roughly speaking. Bit of a mixed picture, but that gives us an idea of what users were expecting. We do know that some operators this year have rebased rents, but I'll come back to this chart when we relaunch the poll answers, and we can see kind of how that has changed this quarter, again, versus the end of last year. In terms of tenancy length, as I mentioned, headline rental growth is obviously an important metric, but increasingly we're starting to look at contract value, and that is then taking into account tenancy length. Now, this is based on achieved rents or achieved contracts for last year as well as for this year. And we can see across all demographics going into PBSA, for last year, about 47.5% were signing contracts at 51 weeks or more, and that has come off slightly so far to about 43%. So the assumptions around tenancy length and that being 51 weeks is not necessarily always correct, but we're going to be, as I say, increasingly able to start to look at this in a lot more detail. As always, though, there will be big differences between demographics. So if we focus on just those contracts agreed by Chinese students, interestingly, they are in most cases taking those longer contracts, so 51 weeks or more. But again, we can see how that has changed. So last year, roughly speaking, about 75% were signing those contracts at 51 weeks. And so far in the cycle this year, that's dropped to about 65%. So again, we're going to keep a close eye on this because clearly tenancy length is going to impact revenue and also gives us another way to look at, revenue rather than just looking at headline rental growth. So there's a lot going on. I guess to summarize, we could go on for a lot longer. There's a lot of data to go through, but I guess some key themes that we have been seeing is that recruitment volatility that I've mentioned. That does still remain a challenge, and that has made it a lot harder to predict. So far this year in the cycle, PBSA leasing velocity is tracking just below last year. But as I say, that spread has been narrowing for the last two months. So we'll see if that crosses into positive territory in the next month or two. As I say, with international postgrads seemingly coming off the last few cycles, there is still quite a lot of demand for affordable stock. We saw the HMO data earlier that suggests that UK students again are reporting increases in their contract values year on year. And as I just said, rent, yes, it's an important metric, but equally tenancy length is also very, very important. And again, it's not one that many stakeholders seem to be commenting on. Before I hand over to Kim, and again, I appreciate there's a lot to cover here today, a few quick announcements. So later this year in June, we will be holding our next annual summit, which we're really looking forward to. We are expecting well over 200 guests coming to the summit, and that gives the industry an opportunity to, I guess, have a data-led event. Lots of panels that we have planned, lots of presentations, and that will enable us and those stakeholders in the room to really keep up to speed in terms of those trends. For anyone that wants to be added to the waiting list, do feel free to scan the QR code. We have to manage numbers, obviously, but again, do reach out and we'll see if we can accommodate you. So again, feel free to join the waiting list through the QR code. And then finally, myself and my colleague David will also be heading to MIPIM in March. Hopefully the weather's a bit better than last year. If anyone is interested in catching up whilst we're there, we're happy to have a chat and run through, again, the latest trends in the market. Feel free to reach out directly to myself or to David. And obviously, again, happy to chat and hopefully we'll get some sunshine, but let's see. Kim, I will hand over to you. So if you give me 2 seconds, I will allow you to take control of the screen. And yeah, so look forward to hearing your thoughts and running through your slides. I think you should have control now.
Okay, just trying to. No. Not moving it, Richard.
Oh, let me try for you. That's okay.
Okay, thank you. So yeah, just again, I'm Kim Nisbett, Head of Data and Insight at Unite Students. And for anyone who's less familiar with Unite, we're the UK's largest provider of purpose-built student accommodation. We have around 72,000 beds across 208 properties in 29 cities and partnerships with more than 60 universities. Our purpose is simple: to create communities where young people can thrive, offering safe, high-quality homes that support academic and personal success. Partnership is a core part of our model, and we have around 60% of our beds on nominations, and we also have 2 joint ventures in progress with MMU and Newcastle University. So yeah, I have been working with Unite for 22 years now, which seems insane. I began my career in finance as a business partner, and that gave me a really good grounding in how the business really makes money, but just as importantly, how to balance commercial decisions with genuinely making the customer happy. For the past 12 years, I've worked in Insight, focused on the student accommodation market. When I started, our data was extremely limited. My first job in the role was to fix our supply spreadsheet. Most of the data was wrong. And I think I spent about 6 months in my job just trying to get that accurate. Today, thanks to partners like StuRents, we have access to far richer and much more high quality insight than ever before. And my team's job is to make the most of that data. So over the last 12 years, my team has grown to more than 18 people across 4 key areas. So we have the insight team, and our role is all about turning data into actionable insight, primarily focused on the customer journey and how we can improve it, but also external supply and demand data. We also have a data science and analytics team, and their role is to use more advanced analytics techniques to support things like our student number forecasting, sales outturn, and scenario planning, and lots of other great stuff. And then we also have data architecture and governance and data engineering, and they underpin all of this great work. These functions only succeed when they operate as a single team and understanding each other's goals and end-to-end thinking about data. We report into the COO, and our remit goes well beyond day-to-day decision support. We help shape the organization's strategy, ensuring data that is embedded into business, how the business thinks and operates every day. So over the years, I've learned a great deal about data, what it can, but also what it can't tell us, how markets react to change, and how long it really takes for a city to rebalance. So what I was planning to cover today, first of all, a deep dive into the new UCAS Live at Home data that you all will have seen and what that tells us. Overall, and moving on to overall entrants and how the market has moved, and then a view on supply and the impact that we're seeing build to rent have.
Next slide, Kim.
Yeah, sorry.
That's okay, no problem.
So over the last year or so, UCAS has started sharing more detailed data on students' intention to live at home, which I'm sure most people will have seen. What this has shown us is since 2017, we've seen a steady and consistent increase in 18-year-olds planning to stay at home while studying. Each individual year on its own looks quite small, but cumulative effect across the decade has been more significant. So to understand what's driving this shift, we asked Mark Corver from Campus Numerics to take a deeper look into the data using the Day 28 UCAS data. For those unfamiliar with Mark, he is one of the UK's leading higher education data specialists, and he's best known for co-founding Data HE, and before that, he served as Director of Analysis and Research at UCAS. On to the next one. What Mark's analysis has showed us was that although the proportion of UK 18-year-olds intending to live at home is rising, because the overall size of the 18-year-old population is also increasing, we haven't therefore seen a drop. This means total demand for accommodation from this group continues to grow despite the shift in living at home intentions. It's also worth noting that the pattern for older age groups remains relatively stable with little change in live at home behaviour. In 25-26, that meant we saw an increase across all major segments, students intending to live at home, those seeking accommodation, and international applicants, resulting in overall accommodation demand remaining relatively strong. The 26-27 application cycle shows a really similar picture. Students seeking accommodation are up 3.3%, and those planning to stay at home are up 4.7%. Although this indicates a reduction in overall mobility, total demand still is increasing. The key takeaway is that while the rise in live at home intentions is notable, it is being offset by the growth in international students and by the expanding 18-year-old cohort. As a result, the number of students needing accommodation continues to rise. Thank you. When we look at live at home patterns by socioeconomic background, a very consistent picture emerges across the data. Mobility rates for UK 18-year-olds have been declining for all groups, regardless of their background. What's particularly notable is that there's no strong indication that the trend is being driven primarily by affordability pressures, such as the ability to pay rent. Instead, the shifts towards staying at home appears to be broad behavioural change affecting students across the socioeconomic spectrum, not just the lower income households. This trend is consistent with what universities and students have been telling us about their decisions being focused on value. We see this message coming through consistently, and it demonstrates the importance of being able to provide value for money across the sector. When we break the market down by tariff group, another clear pattern emerges, and very similar to the other trends that we've been seeing. Demand from students seeking accommodation at higher tariff universities has reached an all-time high. Numbers have climbed to around 160,000, an increase of roughly 12,000 students, or an 8% growth. Early indicators for 26-27 suggest this momentum will continue, with applications from this group projected to rise by a further 8%. This segment remains the strongest driver of market growth. In contrast, medium and lower tariff universities are experiencing modest declines in accommodation, students seeking accommodation, typically in the 3 to 5% range, bringing these groups to their lowest point across the period. This trend aligns with broader shifts in student choice, competition, and affordability pressures. However, live at home numbers are increasing, particularly within the medium and low tariff groups. This signals that demand has not disappeared, it's just shifted. Students are still enrolling at these institutions, but a growing share are choosing to remain at home rather than move into purpose-built or private accommodation. So taken together, the picture is one of a market undergoing rebalancing, strong sustained growth among higher tariff providers, stable but shifting patterns in the middle, and a clear affordability driven towards local study at the lower end. All of this data helps inform where investment capacity planning and product development will be most effective in the long term. I think it's also important, sorry, still on the other side. Sorry, Richard.
Right.
It's also important to recognise that there are both winners and losers within every tariff group. So it isn't, whilst here we're just looking at high, medium and low and grouping them, the reality is that you need to go into a much lower level. It isn't as simple as assuming high tariff providers will win and the lower tariff is struggling. The picture is much more mixed across the board. I think when analysing performance at either a city or university level, it's essential to focus on seeking accommodation applications rather than total applications. As is often the case in this data set, the distinction can materially change the picture depending on the provider being reviewed. Next one. Thank you. Finally, moving on to how that kind of looks across the whole set, the whole group. So what I've looked at here is undergraduates seeking accommodation, first years, and postgraduates. So very similar trends to what Richard was showing us with the HESA data. And the reason I focused on this group is they're kind of the PBSA's core demand. The graph shows a sharp rise in the international postgrad enrolments from 2020 to 22, which is obviously driven by the visa changes that allowed students to bring dependents. And then this is followed by a marked decline in 23, 24 and 25 after the policy was reversed. Although we don't have official sector-wide data for 25, 26 and 26, 27, we can make reasonable estimations using visa issuance data, the data that Richard showed, and also current market observations. All indicators suggest the continued declines in postgraduate enrolments across both years, 25, 26, and we expect a similar small change in 26, 27, while UCAS data shows growth in undergraduate numbers. This has shifted the customer mix towards a more cost-conscious UK undergraduate. Looking ahead, we expect postgraduate numbers to stabilise, supported by a period of policy consistency in the UK and more restrictive higher education environments in the US and Canada. Undergraduate demand is also anticipated to remain strong, driven by a growing UK 18-year-old population and rising international interest. On the next one. So then moving on to supply. Build to rent has become a meaningful part of the overall supply landscape and can no longer be overlooked. While it still represents a relatively small share of total beds, especially when assuming around 25% of units are sold to students, I think Richard used 30, we tend to be around that sort of range, it can have a significant impact at a city level. The graph I'm showing here shows new beds or pipeline that came in between 22, 25, and what you can see, the blue line there shows that in certain cities, build to rent had a significant impact in the extra beds coming into that city. Current pipeline volumes remain well below the pre-COVID levels. Before pandemic, annual delivery was typically between 25 and 30,000 beds. Even when including build to rent, we are still now only seeing between 10,000, 15,000 per year, and we expect that to fall further in the near term. Build viability continues to be being challenged by rising construction costs and delays associated with BSA regulations. It's also important to note that build to rent is generally positioned towards the higher end studio market rather than the more price sensitive segment where we are seeing the strongest growth in demand. And to the next one. So then my final sort of overview of what all of this means. I think PBSA was once a straightforward growth story built on expanding and increasing mobile student cohorts. The sector reflected this, assuming that demand, customer mix and affordability would continue to follow long-standing trends. Today, the environment is more dynamic. Students are increasingly price sensitive, driven by cost of living pressures and closer scrutiny of graduate outcomes. At the same time, the Renters' Rights Bill is set to disrupt the HMO market, creating new opportunities with returners who are seeking greater certainty and quality, a positive tailwind for PBSA. While affordability pressures, rising live-at-home participation, and weaker social mobility have altered traditional patterns, the fundamentals of the sector remain strong. Demand is becoming more polarised, high-tariff segments remain resilient, the mid-market is tightening, and the combined influence of build-to-rent growth and regulation is reshaping the operational landscape. The shift elevates pipeline risk, asset selection, and partnership strategy as core priorities for providers. Sustained long-term value will rely on sharper data, I would say that, disciplined capital allocation, and deeper collaboration with universities to ensure affordability is front and centre.
Thanks, Kim. Much appreciated. And it's great to get your perspective. And I think I know we kind of jest about actually what has been positive to see. I mean, I've been doing this for 10 years as well, so fairly significant length of time. And actually, that quality of data has been improving. There's still a lot to do, but I think the fact that UCAS are now starting to report on live-at-home students, which they've not done before, is positive. So lots more work to do from a data standpoint, but equally there's a lot of progress that has been made. I think also actually it represents how much there's to talk about, because we've almost finished the full hour already, which again means there is a lot going on. We'll try and squeeze in a couple of questions. Before I do that, I'm just going to launch the poll so we can quickly look at the results, if you bear with me 2 seconds. So these should be coming up on screen any second. So to recap very quickly, the first one was looking at rental growth expectations for this year, or 26-27 cycle. Not too dissimilar actually to what we saw last time around. So 1 to 2% is just over half of results. For context, if we cast our mind back to the slide that I had previously, that was 47%. So maybe a slight move towards 1 to 2%. Similarly, from a 3 to 4% perspective, at the end of last year, that was about 36% of replies, and we're now looking at 30. So again, maybe a slight reduction compared to what people were expecting in November last year. In terms of expectations for PBSA leasing velocity, pretty mixed, most kind of neutral to down, a few up, which again, I guess is broadly reflective of the data that we are seeing. And then finally, the last one is looking at shift in terms of market sentiment. I mean, slightly skewed to pessimistic, but I think that's really reflecting some of the data and the harder conditions that we have seen. So we'll keep running these questions in each session. I think it's interesting to see how they evolve over time, and we'll also probably put out some content using those answers as well, so do keep an eye out for that. As I say, we're kind of fairly limited for time, so I'll kind of dive into probably 2, maybe 3 questions if we get to it. You did touch on Renters' Rights Act, and I think there's still probably a fair amount of uncertainty around it in terms of what the impact is going to be. But one of the questions that was submitted was, is there any data to demonstrate the evidence or the anecdotal evidence that HMOs are being withdrawn from the market? And that's going to be a combination of renters' rights, EPC, tax, everything else. I'm happy to give my thoughts first, and maybe Kim, if you want to chime in, feel free. It's an interesting topic. I think we've always somewhat struggled to find good quality data that actually shows that supply over a time series. I don't think there's, I think there's a likelihood that supply will reduce in the medium to long term, and that's going to be positive for PBSA, I suspect. Having said that, though, we do still see interest in the HMO market. I think the fact that Brookfield relatively recently have gone out and bought a portfolio of HMOs. In the last couple of weeks, Homey, which is an operator of HMOs, have raised a significant amount of capital to deploy into the HMO market. So again, I think there's probably a bit of divergence between those, maybe mum and dad owners that basically want to sell and maybe exit the market, versus actually quite a few institutions that want to take more of that supply. So for us, the big question is it the market is shrinking or is it consolidating? And those are 2 very different things. So again, it's difficult to, I think, prove necessarily, but there are certainly some shifts that are happening. I don't know, Kim, if you've seen any data to kind of back up that trend. It'd be interesting to get your thoughts and what your beliefs are.
Yeah, like you said, I think it's really difficult to get a complete accuracy on kind of HMO data. We do have, there's an England only data set that indicates a 9% decline in HMO numbers over the last 5 years. These are just based on council estimates, but the downward trend seems to be quite consistent across them all. There was a recent Times article which referenced data from 20CI in January 2025, and that again was showing 17.4% of all homes listed for sale were formal rental properties, and that was described as the peak of a landlord sell-off. So there are sort of indications and pieces of information there that are suggesting a reduction in supply, but very hard to properly quantify it.
Yeah, no, I think I agree. I think that's been our view as well, to be honest. Just looking at your questions, other ones that are going to be more relevant. So one of them is around the BTR market. So the question is, kind of as rents continue to rise and affordability is very pertinent, how is PBSA tackling competition from BTR and co-living? Again, I'm happy to kind of start. I think it's an interesting topic. I mean, we've both kind of explored BTR. I think there's no denying that it has had an impact on the sector over the last few years. Again, it's very difficult to get good data on the proportion of BTR units taken up by students. Anecdotally, in the conversations we've had, it can be 10%, it can be 70%. So again, it's going to vary significantly per asset. I think having said that, though, I think there's probably, not speaking on BTR's behalf, but probably a desire to not have too higher exposure to students and probably want to limit or reduce that over time. And again, that was actually covered in our conference last year, where an operator was suggesting they have reduced their exposure over time. So I think that is positive in the sense that BTR does not necessarily want to take on students, but the difficulty there is that those assets that are being delivered and mobilised clearly want to fill, and therefore there may be a short-term fix to fill those with students. Interestingly as well, we have heard anecdotally some accommodation platforms that have traditionally been targeted to students, specifically putting BTR on those platforms and actually promoting those directly to students as well. So one to watch, we'll see, I guess, is it a short to medium term negative impact? Again, with supply growth so limited, it may be one that the impact reduces over time, but we'll have to wait and see. I don't know, Kim, if you have anything to add to that.
Not massively. I just think in terms of how we're reacting to it, we're making sure that we're paying attention, we're building it into our supply demand and any decisions we make. And I think also pricing strategies, they are more targeted at the kind of high-end international as well. So it doesn't necessarily impact us so much on our kind of more en-suite university nominations kind of area. So that's where we kind of focus most of our time. But yeah, we're definitely building it into our decisions and our pricing strategies.
Yeah. We'll probably just keep it to one more because I'm conscious of people's time. And again, any questions we don't get through today, we'll follow up on in a separate piece online. There was a question specifically around the Renters' Rights Act and specifically looking at the transitional year for PBSA, which again, I know is one that's some are keeping a very close eye on it. I think maybe some are less familiar. And the question is around how is that transitional year for PBSA going to impact booking patterns? I guess to flip the question slightly, I'm happy to talk about HMOs and then Kim, maybe you'll have a comment on PBSA. It is something we have explored in previous sessions. And again, we don't, I think, fully know the impact just yet. I would definitely go and advise anyone to go and get expert legal advice on the topic. But when we've looked at things like HMO seasonality, as I mentioned earlier, that seasonality is very early typically. And again, one of the key areas of the Renters' Rights Act is that if you are letting a HMO to a student and you want to use grounds 4A, so you have certainty of you're going to get your property back to re-let it within the typical cycle, you cannot sign your contract more than 6 months in advance. Most do. So the current situation is that most contracts in the HMO market are being signed October to January to move in say July. Well, in most of those cases, all of them, that's more than 6 months in advance. So there's a big question at the moment as to what's the impact going to be on the HMO market, and then what is the knock-on impact to PBSA. Again, I don't think we know quite yet. I think it's going to take a cycle or two to play out, but that's one that we are, again, keeping a very close eye on. I don't know, Kim, if you've got any thoughts on the transitional kind of period for PBSA.
Yeah, so I think like probably other providers, we've seeking advice on the kind of implementation of the Renters' Right Act, and we're also involved in the consultation phase. The transitional period for PBSA is unfortunate side effect, I guess, of the changes, but we're happy that our bookings process for the next academic year is only impacted like in a limited way, and we don't think this has been part of any influence on how the students are booking. For the latter part of the booking cycle, it's anticipated that the PBSA exemption will be in place and therefore have a limited impact on us. Like you said, I think overall we're expecting patterns to remain aligned to historical cycles for us. And it's more going to affect the kind of PRS HMO market, and whether that's a positive for us is something we're going to have to watch carefully.
Yeah, time will tell. Yeah. Perfect. Thanks again, Kim, for today. And again, appreciate there's been a lot more questions, but we have run out of time for today's session. Just again, last thing, just say thank you very much, Kim, for joining us. As I say, we will send out the recording to everyone on the session today. As I mentioned, we do regularly put out content, whether it's through our newsletter or LinkedIn posts, so do make sure you're following that. And yeah, just leaves me to say thanks everybody for joining, and enjoy the rest of the afternoon, and hopefully speak to you all soon. Thanks very much, everybody.